Remember that XYZ stock I told you about? It's up 80%. Sounds like familiar party conversation, right? Or the exact kind of hype you hear by the office water cooler. This chart shows a rapid boom and bust, a cycle driven by a psychological trap known as recency bias. We see a particular stock shooting up over a short period and automatically assume that trend will continue indefinitely, ignoring how often these spikes precede a crash. In 2021, millions of new brokerage accounts were opened by retail investors pouring savings into hot tech stocks. Many of those same investors watched their portfolios lose 40 to 90% of their value the very next year. Basing a financial future on the tail end of a hot trend reliably transfers wealth from everyday investors to the sellers at the peak. The reality of the market is harsh. Trying to predict which individual company will outperform its competitors, a practice known as bottom-up stock picking, is historically unsustainable over decades, even for professionals. Warren Buffett missed practically every major modern tech multibagger the U.S. market produced over the last 20 years, including Amazon and Google. This page highlights an uncomfortable truth. His returns over the past 20 years trailed the S&P 500. The sidebar provides the data behind that struggle. Specific stock selection, which consumes most of an investor's time, contributes 10 to 15% of a portfolio's actual returns. If the individual who defined modern value investing struggles to consistently beat the market by picking winners, why do retail investors expect different results? Most investors dedicate 100% of their energy to a guessing game that yields only a fraction of their actual long-term results. This visualization shows the true driver of wealth. Your asset allocation, how you distribute money across broad categories, dictates between 85 and 92% of your overall investment returns. An asset class is simply a group of financial instruments that share similar characteristics and behave similarly in the marketplace. This includes financial assets like shares and bonds, as well as real assets like land and the gold bars seen here. Success in this macro game relies on a single mantra: there is always a bull market somewhere in the world, even as there is a bear market elsewhere at the same time. This timeline tracks the historical rotation of wealth. Momentum flowed through tech in 1998, emerging markets in the mid-2000s, and U.S. tech equities for the decade following 2010. Leadership is in constant flux. Proper allocation means you don't need the impossible skill of predicting the future. You simply guarantee your participation in it. The primary threat to this strategy is a behavioral blind spot called home country bias. Consider a British citizen living in London. It would be highly unusual for them to invest 90% of their portfolio strictly in Germany. Yet, as this text highlights, Indian residents hold roughly 97 to 98% of their investments entirely within India. This concentration creates what is known as single country, single currency, single asset risk, or SCCARs. A localized crisis compounds instantly, simultaneously devaluing your portfolio, your home equity, and the regional economy that pays your salary. Achieving true financial safety requires forcing global exposure of at least 30 to 40% to insulate against localized economic ruin. To build a sustainable portfolio, you must stop attempting to be a full-time manager and focus on your actual day job. This page lists the actual questions an investor must deliberate on: age, financial goals, and exactly when you'll need the capital. Equity should hold money you won't touch for over a decade. Fixed income serves a different role, while real estate is illiquid. Truthfully answering these timeline questions automatically determines your asset mix, doing the heavy lifting for you. Chasing the asset class that did well in the recent past is a reliable losing strategy. Abandoning single stock stories allows you to focus entirely on the macro-level asset allocation game. This visualization represents the core math of investing. Getting your allocation right determines almost 90%